Hello, Namaskar viewers. I am Sanjeev Pandya welcoming you to the Tax Talk with AJ this week right here on ITV Gold. The show is brought to you by Science CPS Services, a professional full-fledged accounting firm located in the state of New Jersey, multiple locations, but they can assist you with any tax matter, any business-related matter, any IRS tax audit matter, no matter where you are in USA. They can be reached at 908-888-8900. Or you can visit their website, sciencecpsservices.com. This show, the Tax Talk with AJ, every week, AJ with the Science CPS Services, CP and MBA, with over 25 years of experience, brings all the knowledge and expertise and valuable input into the show to guide you and to inform you every week on a different topic. So here we are, the Tax Talk with AJ. And with that note, I'd like to welcome Mr. AJ Kumar to the show. Sir, good to have you.
Thank you, Sanjeevji. Thank you for the kind introduction.
Sure, of course. Now let's jump on a topic which is going to be very, very interesting for our viewers, because many of them perhaps are in the business and they are finding themselves doing very, very good. It's all about investments in the real estate, because this is the one area where everyone is, very much inclined to invest money, because real estate are safe investment and they also can give you very handsome returns. But there are some things to be careful for real estate investment. It also comes with the darker side also, what you need to be careful and how you can really do very well. That's what we're going to discuss. So AJ, my question to you is that, is investment in real estate still one of the preferred investment area for South Asians?
Especially for South Asians, Sanjeevji. Real estate investment has always been one of the prime focus. We have a lot of investment options. You can have stocks, bond, US Treasuries, savings account, fixed deposit. But if you take a step back, more interest you want from the system, higher the risk you are taking. Especially in the recent past, the stock market has been acting up. One day it's high, one day it's low. So what investment you make where you can at least relatively guarantee that the money will not go down. I mean, in theory, even real estate investment can go down, but at least you have something tangible over there. It's not going to become zero. It's not a .com stock. It's not something that you bought and somebody can steal away from you. It's not Bitcoin. It's not that crazy risky. So real estate investment has always been, comparatively speaking, a safer investment than the stock market, equity market, or these digital currency type of situations.
Okay, good to know that. Now, here's just one simple question to start our topic. Is residential investment real estate is better, or commercial real estate investment is better?
Well, it depends. It depends on your portfolio. It depends on your comfort level. Typically, generally speaking, real estate investment will give you slightly higher return as opposed to commercial.
You mean residential?
Yes. So in residential real estate investment, you have slightly more headache. So any client, your clients are your tenants. The tenants can call you that this is not working, that is not working. So either you go there, get it fixed, or you hire a management company. In a typical commercial deal, in a commercial real estate, you typically have triple net lease, where your tenant, the commercial tenant, this business is supposed to pay the property tax, the association fees, the cleaning fees. The amount of money you get is a net of everything. Triple net. So there the return are supposed to be lower, but the headaches is lesser as well. So depending on how good you are, what your portfolio, if you are a real estate professional, if you are a realtor, or if you have certain handyman skills, then it may make sense for you to go with the residential real estate investment. But if you want something headache-free, I'm an accountant, I don't have time to deal with this nonsense, I want to invest the money and I want return guaranteed. So most triple net commercial lease are risk-free or lesser headache. Consider a situation where, let's say, CVS pharmacy or Starbucks is your client, is your tenant. So they don't care. That's a $1 billion public company. The rent comes in automatically. You don't have to call anybody. You don't have to follow up. You don't have to chase anybody. If it was a real estate investment, you probably have to call the tenant. Why is it late? Why it's not there? And the tenant will give you a story, a long story why things are not working before the rent is paid.
There you go. Okay, obviously that is the darker side of it. Now let's just talk about the benefits of it and the darker side of it in this episode. One of the major advantages when it comes to real estate investments is the depreciation, because you can depreciate property, and over the years you could have property depreciated very well, where your ownership share is much higher.
You're 100% right. So depreciation, the reason depreciation get highlighted every single time when we talk about real estate investment is because depreciation is an expense that you're not paying out of your pocket. It's a non-cash expense. Let's say if you buy a property for $300,000, you paid X amount of money, $30,000 out of your pocket, and everything else is financed. Every year for next N number of years, you can claim almost $10,000. You're not paying it to anybody, but you're claiming it as a tax expense. It's a depreciation expense, non-cash expense that you can claim, assuming it's a residential property. Typically, residential properties are depreciated over 27 and a half years. Commercial properties are depreciated over 39 years because they are larger in value. That's how the criteria the government defines. But depreciation is a very good non-cash expense that you do not pay out of the pocket, but take the tax advantage. You reduce your taxable income by the depreciation that you can claim before you pay any taxes.
Okay, so that's a depreciation. What about utilities? Is there something about utilities when it comes to advantages and real estate investment?
Absolutely. So anything out of pocket that you're paying as the landlord, it could be water tax, sewer tax, property tax, commissions, management fees, association fees, anything that you're paying out of pocket, consider it as any other business. X amount of rent comes in. These are my expense, including but not limited to mortgage interest, plus the depreciation expense. For most rental properties, the reason is beautiful. The reason everybody wants to invest into real estate investment, because the real estate investment income is effectively tax-free. The amount of rent that you're collecting can barely offset the depreciation, the property tax, the mortgage interest, and all other expenses. After you take the rental income minus all these expenses, your taxable income is negative. Your taxable income is almost zero. That's why you collect the rent and don't pay any taxes on it. Okay. Over the year, the property value increases as well.
All right. What is the 1031 exchange when it comes to utilizing?
I'm glad you reminded me. So 1031 is a rule, a section in IRC, in the Internal Revenue Code, in the IRS book. 1031 is a section, 1031, that defines the real estate exchange. Let's say if you're selling a property and you're buying another property from the proceed of the property that you're selling, then the theory is, I'm really not selling anything. I should not be paying any taxes. I'm selling this thing to buy this thing. So it's actually an exchange. I'm not selling anything. I'm just exchanging two things. Selling this only to buy this. There are rules around it, Sanjeevji. Meaning in a typical 1031 exchange, you have to identify the property that you're going to be buying in 45 days from the closing day of the first property. You can identify more than one property. You have the right to identify multiple properties, but the property must be closed within 180 days. Within 6 months, you must close the property. The exchange has to complete within 180 days. The other thing you have to be careful, you cannot have the money coming into your pocket, meaning from the sale of the first property, you cannot have money coming into your pocket. This money has to remain in the escrow account, has to remain in a third-party account, an attorney's account. And from their account, this money has to go into the next property account, meaning you never see the money, you never receive the money. That's what the exchange means. I gave this up only to get this. I never got any money. That's why I should not be paying any taxes. The reason you do it in a typical 1031 exchange, the capital gain from selling the first property are not taxable, are deferred till you sell the second property that you buy.
Okay.
You typically use 1031 exchange in situations where the capital gains are higher. Let's say if you bought something for $100,000 and you're selling for $110,000, it's not worth using the 1031 exchange. You want to just pay the tax and be done with it. But if you bought something 20 years ago for $100,000 and now you're selling for $500,000, capital gain is $400,000. That's a situation where you should consider 1031 exchange.
All right. So for the smaller gain, it's not worth it.
It's
but
not
for,
worth
for a
it.
larger gain, it's definitely
Absolutely.
worth it. All right. So we have actually more topics to cover in this week's The Tax Talk with AJ, and this week's topic is investment in the real estate, commercial or residential. What are the pros and what are the cons? That's what we are discussing, and that's what the topic is all about. And AJ Kumar of Science CPA Services is giving us all the information that we really need to know. Once again, the show is brought to you by Science CPA Services, a full-fledged professional accounting firm. They have knowledgeable, experienced CPAs on hand. Besides all the staff members, they can assist you with any tax matter, personal or corporate tax matter, or even if you need, a virtual CEO, virtual CFO, someone to do payroll for your small business, mid-sized business, Science CPA Services can really assist you because they have been providing these services for years. They're experienced, and when it's come to taxes, they know that they can do the taxes right. They believe in doing taxes right. So for any tax matter or for IRS tax audit matter, you can give them a call, 908-888-8900, or visit their website, sciencecpaservices.com. With that note, we're going to take a short break. When we come back, we'll continue to give you more information on real estate investments. Stay with us. Welcome back to the second half of the Tax Talk with AJ. Today's topic, which you will definitely enjoy like you do every week, is this week's topic is real estate investments. What are the pros and the cons? And before the break, AJ touched upon 1031 exchange and then depreciation and the overall information about residential and commercial investments. Now let's take this forward. One of the challenges, or maybe perhaps a risk, the owner of any one of these residential commercial property faces is to have vacant space for such a long time, because to have that vacant space, that means you're losing money, you're losing rent income, and you're also paying all the dues that you really need to pay. So in this, for that matter, the passive activity and loss carry forward, how does that work for that owner's tax return?
Absolutely. So even if your property is fully rented, you will still have a loss on your rental property. And why would you have a loss? Because your rental income typically is not able to offset the property tax, the mortgage interest, the depreciation, and all other expenses that you have. So net result, you have a rental real estate loss. If your property is not fully rented, then of course you will have a net rental real estate loss. Typically, the real estate loss is considered as passive, where you're not working actively, where it's a side income. You have a job and you have on the side you have a rental property. So in that case, this passive loss cannot offset your W-2 income. It can only offset your passive income. In order for you to qualify, as an active real estate professional, you have to have some sort of licenses. You could be a realtor associate, or if that's not the case, you have to be investing at least 750 hours if this is your primary activity. If this is not your primary activity, you have to be investing at least 1,000 hours. It's very hard to justify 750 hours, 1,000 hours if you are not a real estate professional, especially if you have one property. If you have multiple properties, you can count the number of hours for all the properties together to justify that you are an active real estate professional. The idea here is, if you are an active real estate professional, your rental losses can offset your other income, your other active income. So look at your situation, especially if you have multiple real estate. See if you can qualify for active real estate professional.
What does a tenant have to do to qualify for real estate professional tax status?
It's not about tenant. It's about the landlord.
The landlord, I meant to say landlord. Yes,
so
my
landlord
bad.
can qualify as a active real estate professional by the mean of showing that I'm a realtor or a realtor associate. So I go around showing a lot of properties. Or I don't have any other business. This is my primary business, maintaining certain logs, certain travel records. Or by saying that I have 10 properties, how the hell do you think I'll manage 10 properties if I'm not spending at least 80 hours, 100 hours per properties in the whole year? There are 52 weeks. If you're spending 2 weeks with 10 properties, you are there, you are done. So you have to maintain certain records. The onus, the responsibility remains on the taxpayer to justify as why did they claim themselves as a active real estate professional. And as you would imagine, this is highly prone to tax audits, especially if you have a large W-2 income. If your W-2 is, let's say, $100,000, and you're trying to claim real estate losses with one property as active losses, the audit probability is going to be higher.
Interesting. How do you utilize the property zone establishments? There are certain zones, and how do you utilize to invest in the certain zones offered by town or county?
Absolutely. So there are certain opportunity zones. There are certain areas that are not as well developed. So state identifies those areas as opportunity zone areas. The idea is if you invest into those opportunity zone, and if you keep the money invested in there for at least 5 years, then your basis is increased by 10%, meaning your capital gain is reduced by a certain amount. If you keep the investment in the opportunity zone for 7 years, then it's 15%. If you keep the money for 10 years invested into the opportunity zone, a lot of times you don't have to pay any capital gain tax. And you ask, why would the government do it? Opportunity zones are the areas where underdeveloped area. Government wants people to come in that area. They are probably risky areas. Imagine a situation when this whole state, 80% of the state is developed, 20% is not developed. There must be a reason why it's not developed. So state is trying to create tax benefits to have people come in and invest in those areas. So those areas can be developed as well.
All right. Once the investment is done, is LLC is the best option for real estate investments, or there is another option as well?
Typically, LLC is what we use for real estate investments. The other option could be S Corp, depending on how many properties you have, or if you are just a management company, not owning the real estate. So real estate business does not necessarily mean I have to own the real estate. Real estate business could very well mean that I'm the managing company. I have 8 handymans, 8 people working for me, and we have 50 properties that we are managing. If they need anything, we send our person over there to get it fixed, and we charge the landlord. That's another business. Those type of businesses could be S Corp, but S Corp requires a payroll, and S Corp is beneficial when you have positive profit. Real estate companies typically will show negative losses, not the profit, only because typically the rental income is lesser than the property tax, depreciation, mortgage interest, and other expenses. So it wouldn't make sense to have S Corp for a real estate company a lot of times.
Okay, and just like any other business, does a home office and a business expense can also be taken as a deduction?
Absolutely. So consider it as any other business, as you said, Sanjeevji. So anything that you have, if you had to pay the accountant something, if you have to buy certain brochures, business card, use home office, as long as you're using the home office exclusively and regularly, it's a separate area. It's not that I have a table in my bedroom type of situation. As long as it's a separate area, separate entrance, no bad, used exclusively, used regularly, it's all game, like any other business.
Okay, interesting. Is there a section 179 has to do with some kind of bonus incentive, something?
Oh, yes, the depreciation section, Sanjeevji.
Okay.
So depreciation, the example that we took, let's say if you buy a property for 300,000 and it's a residential property, you divide it by 27.5, so you can claim almost $11,000 of depreciation on a straight line basis. Section 179 allows you to depreciate larger depreciation in the beginning of the year. So larger the depreciation, lesser your taxable income, and lesser taxes you end up paying.
All right. As we are winding down, most of the topics here in the real estate investment is the topic, and we're winding down the pros and the cons of the real estate investment. The last one I have is a harvest tax lease. How does that work?
So the concept is referred as tax loss harvesting. So if you have in a year a lot of passive losses. Then you can find certain areas. Let's say you have 10 properties, and you're deciding when should I sell this property. You try to sell the properties when you have a lot of losses from other properties, or vice versa. When you sold the property and you have large gains, that's the year you don't mind claiming large losses. So the losses can be used to offset the gains. Tax loss harvesting is typically used in the stock market more so than the real estate market. The idea is, if you sold a stock and you made large amount of money, that's the year you want to identify the stocks where you are losing money, so you can sell them and use that loss against the taxable gain that you have by selling the stock.
Okay, interesting. Now, what kind of tip that would you give to someone starting out, very first time investing in the real estate, has some money and want to let's say invest into a two-family apartment or four-family apartment, something like that. What is the best advice that you can give, or what's the first thing that they should really be careful for before they make any investment?
Well, before they make any investment, they have to make up their mind. They have to know 90% of the millionaires in this country are made by real estate investment, as we discussed in the first half.
Including our president.
So knowing that this is a good way to get to the next level, you make up your mind that need to, like any other business, there will be a lot of hurdles, a lot of challenges, a lot of new things that you have to learn. Make sure you're going slow. Don't bite more than what you can chew. You don't want, if you have $50,000, you don't want to be buying a four-family property. You want to be going slow. There are a lot of real estate investment courses that will tell you, that preaches to put lowest amount of money possible as a down payment, take large loans, but make sure you do your calculation right. How much money you are paying out in terms of interest, in terms of other expenses, and how much rental income you're getting. Keep it sane. Don't go crazy on either side.
Okay. Good question. One or two questions very quickly, as we have less than 2 minutes to go into it. What are the tax incentives for a long-term real estate investor?
There are a lot of tax incentives, Gigi. So imagine a situation when first all the real estate income, the rental income, you don't have to pay any taxes, because with the depreciation, which is non-cash expense, again, mortgage interest, property tax, all these expenses are offsetting the rental income. Second, your property value keeps increasing over the years. So if you keep the property for n number of years, say 15 years, now you have a property which is mortgage free, and now you keep the rent and you don't have to worry about the mortgage or the other expenses. Real estate has become a backup for the retirement plan. People are thinking about buying a two-family, four-family home to substantiate the social security. There are a lot of talks about if the social security income is going to be there or not, but you don't care. If you have a four-family home, each apartment is paying you $2,500. After taking out all the expense, you are working now. In next 15, 20 years while you're working, try to pay it off. Mm-hmm. After you paid off the property, the only thing you have is property tax. And then after you keep collecting the rent, this becomes your retirement plan.
Amazing, very good. Last question, 30 seconds. How can one avoid IRS tax audit as a real estate tax professional?
As much as it's important to avoid. So don't go crazy. Don't claim the active losses if it's truly not active, if you don't qualify for it. But more importantly, plan for the worst. In the sense, keep the receipts, keep the log. Make sure you have one account, create an LLC, use that LLC bank account to create all the expenses. Don't commingle the expenses. Don't have some expenses going to the personal account, some expenses going to the business account. So just in case, in the worst case scenario, if you get audited, you have everything lined up for you.
Everything should be transparent. Okay, as much as possible, and that makes it easy. With that note, we come to an end of this week's The Tax Talk with AJ. I'd like to thank AJ of Science CPA Services for his valuable input, advice, and information that he shares with us each and every single week in the show. Remember, the show is brought to you by Science CPA Services. 908-888-8900 is their phone number, and the website sciencecpaservices.com. Until we meet again, same place, same time, I'm Sanjeev Pandya, wishing you all happy and tax-free days ahead. So long.
Thank you.